Hello. Today we are going to do a brief analysis of Vedanta Limited's balance sheet and with a greater focus on its debt. So, big focus on its debt. How is the debt looking at? How much debt it has to pay? So, let's start. So, first, this is its earnings presentation for fiscal year 2026, the first quarter. And we are going to get all our information from here, plus something more. So, let's start. Now, this here shows the net debt of the company for quarter one fiscal year 2026. A lot of figures, but first, what is net debt? Net debt is long-term debt minus cash and cash equivalents. Cash equivalents are assets which can be easily converted into cash, very easily converted into cash. So, cash and cash equivalents subtracted from net debt. Now, as of June 30th, 2025, the latest timeline, the net debt of the company is 58,220 crores. So long-term debt is 58,220 crores more than cash and cash equivalents. Oh, my fault. If we compare this to March of 2025, 31st March, basically a quarter ago, that was 53,251 crores. So net debt has increased, which is not a good thing. Well, it depends. In relation to other things we can see, but net debt has basically increased. The gap between long-term assets and cash equivalents in one quarter has increased from 53,000 to now currently standing around 58,220 crore rupees. Moving on, we have a balance sheet and debt breakdown. This shows the net debt, which we just discussed, compared to the EBITDA or earnings before interest, taxes, depreciation, and amortization. The smaller this ratio, the better. Currently standing at around 1.3 as of quarter one fiscal year 2026. 1.3. If we compare this to quarter one fiscal year 2025, just above me, it was 1.5. So within 1 year, it has gone down from 1.5 to 1.3. So that's pretty good. Oh, again, my fault. Yes. So here we have the debt breakdown. The company has $8.69 billion US dollars of term debt, long-term debt basically, with or 74.41 thousand crores, 74,000 crores worth of long-term debt. Then working capital debt is used to fund, well, again, working capital. This is more of a short-term debt. It's around 0.63 thousand crores, 0.63, still a big number. Then short-term debt of 5,300 crores. So long-term debt of 74,000, short-term debt of 5.31 thousand crores, and working capital debt of 0.63 thousand crores. Still a big number, bringing the total debt to around 80,000 crores. 80,000, how will we say this? 360 crores. Yeah. Or $9.38 billion, US billion dollars at the exchange rate as it is. Not this exchange rate, the exchange rate around when this report was released. That's the total debt, but cash and cash equivalents of 22,000 crores. 22,140 crores of cash equivalents, bringing the total net debt to 58,000 crores, as we saw earlier. Then 82% of this debt, right, is in INR. All right, it's in INR, Indian rupees, while 18% is in a foreign currency or in USD. So majority they have to just pay back in rupees. 18% they have to pay back in foreign currency or the US dollar, which is again foreign currency. Then average term debt maturity here is mentioned. Average term debt maturity maintained 3 years. So how much time will an average term debt last for? 3 years. It's maintained, it said. Then the interest expense is 9.66%. All right. Reaffirmation in credit ratings. So ICRA and CRISIL, these are both credit rating agencies, and both have given Vedanta a double A, which is a good rating actually. Double A, the good rating, with the outlook being watch with developing implications. So they're keeping a watch on this company. Not stable, not positive, but just looking out, carefully looking at what's gonna happen, but where? At its parent company, Vedanta's parent company. That's a concern. But we will also look into that. So looking at the debt, they have mentioned continuous deleveraging. So it seems that Vedanta Limited here, like see Vedanta Limited, and also Vedanta Resources, its parent company. This has been a cause of concern for, you know, Vedanta Resources has a lot of debt, and this is the parent company of Vedanta Limited, the company we're talking about. Now, here they have said that their net debt to equity EBITDA ratio, net debt to EBITDA ratio of Vedanta Limited, not the parent company, only Vedanta Limited, is 1.3 net debt to EBITDA ratio. And they're saying that the global and Indian players have a net debt to EBITDA ratio of 3.2, 3.6. So lower this ratio, I believe the better. You lower this ratio, the better. So it seems that compared to the industry average, it has better debt. All right. And here they said the closing interest cost stands at around 9.2%. So they have to pay 9.2% interest on their loans. And it's down 130 basis points, which is 1.3 percentage points. So earlier it was 10.5, the interest cost. Now it's down year on year. All right. An average term debt maturity is maintained 3 years. So the average time it would take for the term debt to mature, a term debt to mature is 3 years. And Vedanta Resources, this is the concerning thing. This is the parent company who owns majority of Vedanta Limited, and here they have shown some very impressive deleveraging. Now the group, meaning this company, I think that means that yeah, the group Vedanta Resources Limited, their net debt to EBITDA has declined from 3.3 times in fiscal year 2020 to 2.7 times in fiscal year 2024 to 2 times in fiscal year 2025. And in the medium term, I don't know what the medium term is, could be 3 to 5 years, but medium term is about to be one or close to one. So the debt situation based on this number alone seems to be getting better as EBITDA is becoming larger and larger part of net debt. What am I saying? When net debt is compared to EBITDA, it seems EBITDA seems to be catching up, which is a good thing. Um, Here they show the net debt. It was $8.9 billion as of March 2022 for the VRL, the parent company. This dropped down to $5.6 billion by March 2024, and by June 2025, the latest. Okay, quarter one fiscal year 2026 is same as June 2025. This dropped down to $4.7 billion. Then this is the debt maturity. From what I understand, this is how much they have to pay. This is in billions of dollars. So in fiscal year 2026, they have to pay around $320 million or $0.32 billion in debt. They have to pay $780 million in fiscal year 2027, 0.36 or $360 million in fiscal year 2028, and you can see the progression. In fiscal year 2034, they have to pay $550 million back to borrowers. All right. And here they have given a few statements. VRL or Vedanta Resources Limited has deleveraged by $227 million in quarter one fiscal year 2026, decreased their loans by $227 million, and for remaining fiscal year 2026, repayment of loan $320 million and interest will be managed will be managed from mix of internal resources and refinances. So internal resources like dividends they get from the subsidiaries, all right? And refinancing, they will take on new debt in order to pay back old one, which sounds suspicious, but I guess that's okay. It's not like consumer. Companies can do this. And here we saw this. Vedanta Limited, the company, the mining company we're talking about, their net debt to EBITDA is 1.3 times. We already saw it was 1.5 times 1 year ago. And in the near term, they're saying it's going to be less than 1. Net debt to EBITDA is going to be less than 1. EBITDA is going to be more than net debt. That's what they are saying. So let's see if they can achieve that. In a summary, it seems both have seen continued deleveraging. Moving on. Yeah. Here we have a summary of income statement. Summary of income statement. We can read all this, but okay, you can read all this. You can pause and read all this. Main thing I want to see is focusing here. One stat only. Actually, a couple of stats only. You can see EBITDA. Okay, these are in crores of rupees. And you can see finance cost. So finance cost can include interest cost, plus can also include, I believe it can include repayment of borrowings. I think so, but I'm not sure. I think it can include repayment of borrowings. So finance cost, let's say it's interest and EBITDA. Focus on that. So in first quarter of fiscal year 2026, okay, we have EBITDA of 10,746 crore rupees. We have finance cost of 2,026 rupees. When EBITDA is divided, all right, when EBITDA is divided by finance cost or interest cost, this is known as the interest coverage ratio. The higher it is, the better. Interest coverage ratio below 1, meaning the finance cost or the interest payments are more than your EBITDA. That can be a really big concern. Not a really big, but that can be a concern. Above 1, nice. It's near to 1. Okay, if it's 2, if it's 3, better. Well, 2 or 3 is like, yeah, safe as far as I know. 4, 5, 6, good. Right now, EBITDA divided by finance cost is around, looks like 5. So interest coverage ratio seems to be 5. Let's talk about fourth quarter, fiscal year 2025. We have EBITDA of 11,618 crores and finance cost of 2,583. That is around 10, sorry, that was around 4 point something interest coverage. Then 10,275 crores in quarter one, fiscal year 2025, and finance cost of 2,222 crores. Again, it's around 5. So 4 point something to 5 is the interest coverage ratio. At least we see the few quarters, latest quarters. And in my opinion, that's pretty comfortable. That's pretty nice. That's pretty nice. Moving on, we have the entity-wise cash and debt. All right, this is useful because it shows Vedanta Limited and all of its subsidiaries. All right, we're going to look only for June 2025, or let's first look for June 2025. So for Vedanta Limited alone, the stand-alone company, it has a debt of 46,859 crores. So earlier, we saw that figure of 77,000 crores as the total debt, right? That was consolidated. So that's Vedanta Limited plus its subsidiaries. Right now, we're talking about standalone only, so only Vedanta. All right. But it's going to combine all this in the end, at the end of this table. So 46,000 crores of debt and cash equivalents of 8,000, a net debt of 38,000. So debt is way more than cash and cash equivalents. Then we come to the kind of the cash cow, Hindustan Zinc Limited, with a debt of only 13,524 crores, cash and cash equivalents, the highest among the group of 9,340 crores. So we can see it's kind of like the cash cow. It really helps the company. Then we see Came India Holdings. They have given a note here. Came India Holdings, oh sorry, Cairn India Holdings, Cairn India Holdings is a wholly owned subsidiary. of Vedanta Limited, which holds 50% of the group's share in RJ Block. So RJ Block must be something. So Kane Holdings has cash and cash equivalents of 22,049 crores. All right. Then we have got Balco, nice name, cash equivalents of 1,137 crores, cash and cash equivalents. So if all these subsidiaries, we can see Vedanta really has a lot of debt, as is expected of the this, of course, the main company, bringing the total debt to 80,357 crores. Okay, cash and cash equivalents of 22,137 crores. And we have, what is this? Net debt of 58,220 crores. All right. Now, this was for this quarter, the latest quarter. If you want to compare to last time, we can see net debt is actually higher. So, 1 year ago, okay, first quarter fiscal 2025, net debt total was 61,000 crores. Right now, 58,000. So, at least in yearly wise, it declined. That's good. And finally, and finally, we have the funding sources and the term debt maturities for, I think, this company alone. So how much, I believe, how much debt money they have to actually pay back in the next coming few years. Now here we can see 57% of their loans are in INR, term loans. Okay. 57% of the total funding for the long-term debt comes from term loans in Indian rupees. Then 24% of the total funding of the debt came from issuing bonds in Indian rupees. 19% came from issuing loans in foreign currency, and 0.1% came from issuing bonds in foreign currency. The long-term debt maturity is 8.7 billion, 74,000 crores. You already saw this figure. And it seems, from what I understand, they have to pay, as of now, like quarter one already happened, fiscal year 2026. So the remaining 3 quarters of fiscal year 2026, they have to pay 8.5 thousand crores. Okay, in fiscal year 2027, they have to pay 25,000 crores of debt, 16.8 thousand crores in fiscal 2028, and fiscal year 2029 and beyond. I hope this beyond means it's an accumulation. Okay, it's an accumulation of how much they have to pay. I hope it's not every year. Could be every year, who knows? 23,700 crores of debt they have to pay. So these figures uh, look massive, and they are massive. All right. So last thing I want to show is the cash flows. That's the very slow transition. This is the market cap and all. This is the company itself. Big company, big company. Okay, 1.76 lakh crores is the market price. And disclaimer, I own some shares of this company, which now makes me doubt after seeing the debt. But basically, I am biased towards the company. So current price of one share is 450 rupees. Return on equity, really nice, 38%. Return on capital employed, 25%. Stock PE ratio, price to earnings is 13.1. Thing I want to show was cash flows. All right. These are the company's cash flows. The real cash the company makes, not the profits. Profits is on paper. Cash flows are real cash. Okay. So pay attention to this cash flow from operating activities figure only. All right. Not this, not this, not right now at least. So, whoa. So as of, hold up. Can you actually see that? I don't think so. Okay. March 2014, cash flow from operating activities of 15,601 crores. You can already see this is more than a decade ago. They have massive cash flows. 2017, we have cash flows of 18,083 crores from operating activities. 2020, 19,300. 2022, massive jump to 34,963 crores of free cash flow. Sorry, of cash flows only. And we can see in the last few years, cash flow from operating activities has consistently reached and breached the 30,000 crore mark. As of March 2025, we reached cash flows from operating activities of 39,562 crores, right? 39,000 crores of free cash, sorry, of cash flow from operating activities. And this massive cash flow will help them in paying off this debt and all. This is the real cash that is coming in. This cash will be used to pay interest. Okay. So 39,000 crores compared to how much debt they have to pay of 24,000 and all that. Okay. And again, cash flow from operating activities does count. This figure is already included expenses like operational expenses, expenses of running a mine, and all the expenses that Vedanta is going to have. So this 39,000 crores, this can go towards future investment by the company and what else? Future investment by the company plus debt, yeah, paying down debt and all. So this is the one of the big things. This cash that they have, cash flow that they're generating, it's going to be used to pay debt. So this was the situation of Vedanta. It seems that the net debt to EBITDA is getting better for both Vedanta and its parent company, which has been recently been a news of concern, the debt. But they have a lot of debt, 77,000 crore. Oh, no, oh, what was it? I forgot, 80,000 crores of total debt, 80 something thousand crores of total debt. They do have some really, really solid cash flow from operating activities, 39,000 crores. And improving net debt to EBITDA, comfortable interest coverage ratio of 4 to 5. And they do have to pay a lot of debt, but they do have some really, really good cash flows from operating activity, massive cash flows. So that's it. That was Vedanta Limited's debt analysis, if you can call it that. Double A rating.